Two stocks to consider for May of 2023. I started doing these videos since I believe 2 or 3 months ago, and many of you are really liking them. Many of you actually enjoy them. It's one of your favorite videos on YouTube channel. I'm very happy to hear that, but unfortunately such videos, they don't get a lot of views because I'm not targeting any keywords like Apple or Google or anything. So all I ask, if you could please press the like button if you actually enjoy them, and maybe consider subscribing if you're actually a new member. Now typically I start these videos by talking about the two stocks I talked about in the previous video, and then I'm gonna get to two new stocks I haven't talked about them before that I believe are actually good buying opportunities at such prices. The first stocks that we talked about in the previous months was AVB, Avalon Bay Communities. I gave my thesis on why I believe REITs are undervalued. The yield was around 4.5%. It was pretty great. Now the stock is up over 11% since I talked about it on YouTube, and we bought it in the group, in my investment group, around $154, and we collected the dividend. So in total, we're up over 18% on Avalon Bay Community in 5 or 6 weeks. And the chart is pretty bullish on the company. It broke out a long-term, downtrend from March of 2022. So I really like this company. It could be a good, long-term investment. The second one, which also started moving, is BTI, British American Tobacco. I talked about this stock like 2 or 3 times before. It started to move. It's up over 5.5% over the past months. It's pretty great for such company with over an 8% dividend. So yes, both of those are actually working out amazingly well. But before I get into the first stock, I would like to remind you that this is not financial advice. I'm not telling you to buy them or sell them. I'm just giving you an idea, and I tell the people in my own group whenever I decide to buy them or sell them, because I don't want to make 100 videos a week. Whenever I sell something or buy something, this is not a Warren Buffett hold forever type of investment. I might decide to sell it tomorrow. I might decide to sell it the next week or the week after. So don't just assume that if I bought something, it means I'm going to hold it for 20 years, or anything like that. Now, the first stock, which is very undervalued, and it finally got to my fair value level, was actually GEO. I made many videos on the company, and I said on Twitter, after recommending staying away from GEO at $10 per share, which actually got a lot of hate because GEO has some type of a cult following where if it goes to 10, they say fair value is 15. If it goes to 15, they say fair value is 25. And GEO is pretty much always undervalued. But you have to think about those things in terms of a risk reward, and this is where people were missing it when GEO traded close to $12.50 per share. But I do believe right now it's in undervalued territory. I tried to put it on Twitter. It's up over 6% since we talked about it on Twitter on $7.12, and the stock has been going down a lot, and I'm gonna discuss it in today's video. Now, GEO is an undervalued company trading around 7.5 times earnings. I believe most of you are familiar with it because I talked about it many times. But GEO is a Michael Burry stock, and they own a lot of private prisons, type of care, healthcare type of facilities, not healthcare, but more for care, around the whole thing with the prisons and all these type of things. I know some of you might have moral hazard around the industry, which I understand. Maybe you'll find my second, stock a little bit better if you invest with moral hazard, which I actually don't. Now, GEO has a diverse type of revenues. 44% is from the federal government, 16% is from the state, 8% is international, 21% is in electronic monitoring devices. They are the only contractor for the US government and the states in terms of those electronic monitoring devices. It has been a high growth area within their revenue base and their net income base. They have much higher margins than just running those prisons, and 11% in re-entry services. Now, the problem is that 44% of their revenue is from the federal government. And you've heard many times the current president saying they want to end private prisons. So they stopped actually renewing the contracts whenever they expired. And whenever they expired, they don't want to renew the contracts, but the states are actually interested in taking those contracts away from the government. For example, GEO had an idled facility. It wasn't being, leased or anything because the government ended up canceling the contract. And on April 19, they actually entered into a lease agreement with the state of Oklahoma for them to rent the 1,900 bed facility, which was idle, and they're gonna collect an extra $8.5 million from it, or over a 5-year type of lease, which is pretty great because many of you worry that maybe they don't want to renew the contract. What's going to happen to those prisons? Well, either they get sold for much, much more than they are worth because it's very hard to build prisons these days, or maybe the states is going to lease them instead of the US government. So this is what's been happening with GEO, as they did issue an updated guidance, which was around between 105 to 125 million of net income. And I believe this is, great for the company. And I talked about it many times. I suggest actually watching some of my videos before if you want a deeper look, on GEO. But here I highlighted some of the catalyst or the potential catalyst that I see happening with GEO. And then I talked about my valuation model in the bottom, and I'm going to go through it right now. Now, one of the first catalysts that could realize the value with GEO is actually Title 42, which is ending on May 11. It should increase, border traffic. This is what the management said on their own earnings call. The second thing the management said on their own earnings call is actually a potential, a budget bill from the president or from, maybe, the Republicans or anyone that actually want to raise the debt ceilings. They have to, put up a budget bill eventually, and it could actually increase the budget for ice beds, additional ice beds, which GEO actually has, and this will help GEO in a positive way. The most and the biggest and the most major catalyst, in my opinion, is a Republican president in 2024, and this is going to cause a massive change in sentiment where a lot of people and a lot of funds might actually feel more comfortable investing in GEO if the president is not saying that they want to end private prisons. So this is going to be the massive catalyst, for GEO. Now, something else the company said on their earnings call is that the interest expense will be lowered by 25 million every single year. And this has been the biggest problem with GEO. And if you look at their debt, now their debt, they have around $1.8 billion of debt for a $900 million company. That's actually a lot of debt. And the debt was maturing in 2023 and 2024. Around 6 or 8 months ago, which is why GEO was actually trading at $5 per share. Now, many people are not buying GEO. They tell me, no, I'm waiting for GEO to get back to $5 per share. But the only reason GEO went to $5 per share was because the debt was maturing in 2023 and 2024. The company was going to default on this debt. But they actually did restructure the debt at higher interest rates, but they were able to push it to more around 2027 to 2028, which is going to help the company survive, for the time being. So what I did in this chart, I actually put for 2023, 225 million of free cash flow. This is their free cash flow for this year. It's going to be around 225 million. And I put in that the free cash flow is going to increase by 25 million. As they pay down their debts, they're going to save 25 million of interest expense. And this will end up around 300 million of free cash flow by 2026, assuming everything pretty much else stays the same. And I believe this is a pretty conservative estimate. Now, if you combine the free cash flow that they earned from 2023 to 2026, you come up with $1.5 billion of total capital, and I subtracted it by 1.8 to $5 billion of debt, I ended up with $775 million, which they're going to pay off more than $1.1 billion of debt in those 4 years alone if they actually haven't sold any assets, which they could potentially pay more debt. So they're going to end up with around $775 million by 2026 to 2027. And this is where the big maturity date is between 2026, 2027, and 2028. But this is the trick. They might end up with 775 million of debt, but they're going to be making 300 million of free cash flow. So 300 million of yearly free cash flow with 775 million. I am sure GEO can actually get a refinancing program put in place, and they can maybe refinance it and push it up maybe to 2030 or 2031, where they could potentially wipe out their entire debt. But this is my valuation on GEO, that after they pay down the debt, after the sentiment changes by 2026 or 2027, GEO would be making pretty close to $300 million of free cash flow. Now, I put in a 10 free cash flow multiple, 10 times free cash flow multiple, which I believe is extremely undervalued for GEO, and is a pretty fair number. It could trade lower, but I believe 10 times free cash flow is pretty safe bet with the kind of better balance sheet and the better track record GEO is going to have by 2026. This would be a $3 billion market cap. The current market cap is around 938 million, which is more than a 3x, in my opinion, on GEO. And in my opinion, it could actually be a little bit higher because maybe GEO in 2026 or in 2027 might actually decide to convert back to a REIT and maybe start paying a dividend again. This would cause a massive, fund inflows, a massive change in sentiment where you're actually getting paid to be holding GEO if they reinstate the dividend or they convert back to a REIT in 2026. This would push up the free cash flow multiple much more than 10. In my opinion, at least 13 to 15, which could be a 4 or 5x on the company. But even if I was like 50% wrong instead of a 300%, I could still make, I don't know, maybe 100%, at least 50% or 150%. So there's a lot of margin of safety with GEO, in my opinion, around $7 per share or below. I think it's an amazing, buying opportunity. There's a lot of risks that could go on, some other type of risk, which I don't believe, is something major, but there are some risks with the company, of course. But I believe $7 per share or below is going to yield amazing upside over the next 3 to 5 years with the company. Now, another stock that I really like and I believe it's undervalued is actually Verizon. I have done a video on Verizon, which I would encourage you to actually go and check it out. But I believe Verizon is actually near an inflection point in their free cash flow and in everything. Now, if you look at the free cash flow, it has pretty much been going down, a lot. From around $23.5 billion of free cash flow in 2020, it went all the way down to $14 billion of free cash flow in 2022. But now the free cash flow is expected to start actually rising again from 14 billion to 17, around 19, 19.5, 20.5, over 21.5 billion by 2027. And this is because Verizon is nearing the peak of their CapEx spending. They spend a lot of things on infrastructure, a lot of things on CapEx maintenance, and many of those other things. And they said they are nearing the peak and they want to reduce it over the next few years to around 17 billion of CapEx, which is really going to cause a massive, a free cash flow expansion. It's going to make the dividend more safe, which is pretty close to 7%, their highest dividend pretty much ever, or since 2010 to 2011, a 7% dividend is going to cause a massive change in sentiment. It's going to show that the dividend is actually safe, that the company can finally start paying down some of its debt. Whenever you have such inflection point in the free cash flow, you also have an inflection point in sentiment, and there's extreme bad sentiment around Verizon, and I believe this company is undervalued. You could do a lot of things with it. You could get it for the 7% dividend. You could sell covered calls. You could do a lot of things, with such companies like, Verizon and British American Tobacco. But I believe it's very undervalued, and I would encourage you to check out my Verizon video, which goes in more detail around Verizon. So this was my video for the month of 2 undervalued stocks to consider. No financial advice. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.